So I figured we could have a bit of a talk and sketch session about bonding curves. So primary bonding curves, secondary bonding curves, the differences between them, and also something I think is sort of still underdefined, which with the common stack I started calling a commons market maker. But actually, I'm not sure I'm 100% happy with that term, just because it brings in sort of disparate concepts like the commons and markets, which a lot of people seem to hesitate when they see those in the same term. So maybe I'll start with the SAM mechanism because so many people are already familiar with this. So if we start, let's see here with, we've got SAMs. Apologize for my messy writing. And one of the things that I think is important for us to do on these with these mechanisms is differentiate terminology. So with a SAM, you have kind of two main functions. You have buy and you have sell. So these are the actions that people can take, and they will come along and they will put in one token. Let's say maybe it's $1, and they will get out another token. So this is, I mean, this doesn't have to be dollars to tokens. There are stable coins representing dollars, but essentially secondary AMMs are a place that people can come and exchange between tokens. So you put one token in, you get the other out according to some invariant ratio. We've talked about these before. You can have the x plus y, x plus x times y equals k. Of course, you can have far more sophisticated invariants. And of course, the sell option is kind of the inverse. So you put token in, you get the dollar out. Whoops. So this is, I think, the basic functionality. And I mean, I don't want to go too far into SAMs because I think there's so much literature out there on them already. Uniswap, Curve, Balancer, Bancor, all of these essentially act as, in their base functionality or in their most used functionality, as secondary AMM. So they don't produce the tokens. This is why we're calling them secondary, because they are not about the minting or burning of the tokens. It's just about exchanging those tokens between this ecosystem and that ecosystem. Any questions on SAMs? I know we haven't really gotten too much into it, but I was just going to differentiate between SAMs and PAMs, and maybe I'll just give a second. Wow, this is not really a great.
I could not. It took me about 5 minutes to figure out how to get the mute off here. But I wanted to say earlier you had x plus y equals k. That's a cool invariant function. That's a constant price. You can have an absolute constant price with no slippage with the x plus y equals k invariant function.
Right. So one of the things I think is important to touch on here is each kind of implementation or each function that bonding curves are deployed to fill. For example, in exchange, there is probably, and I mean, there already is, if you just look around the AMM space and what's been deployed, the number of invariants, the number of tokens that can be included in these pools, the fact that tokens don't have to be issued at equivalent ratios. You could have a weighted pool where one token has 10 times sort of the weight of another. So there's all sorts of different ways that we can customize these invariants and create different sort of affordances for the system users based on how we set up those invariants, how we give access control. But we're going to touch on a bit more of this in a little bit. So in the meantime, I'm going to jump into the, I guess I'll just keep this color, into PAMs. So PAMs are about minting and burning. This is not that real time. Apologies. Got to write slower. Burning. Okay. So ultimately, this feels a lot similar to the buy and the sell, because in the mint and the burn, it's essentially a similar type of thing happening. Money goes in, token comes out. Come on. Jeez. I guess I don't need to be a perfectionist on these. And then same thing on the burn, token goes back in, the money comes back out. Oops, that I will fix. So the difference between these two systems is the SAM acts as a price discovery mechanism because when anybody buys or sells, essentially the ratio of those tokens to other tokens in the pool is shifting, and that creates a change in the price of the tokens based on whatever invariant rule exists in that SAM. With the PAM, it's a little bit different. The PAM can be considered a supply discovery tool. So maybe I'll just write that down here quickly. SAMs are for price discovery. Oh man, this is almost unusable. Okay, price discovery, and PAMs are for supply discovery. You'll just have to imagine. So the key behind this is we in most crypto ecosystems today, we have either static tokens or infinite tokens. There's a spectrum between launching a ecosystem with only a set number of tokens and it's never going to change, or an ecosystem where we have basically the ability to mint, fiat style as much as we want. A lot of projects kind of tried to hack together a dynamic supply by taking a fixed supply and then issuing it over time. So in Bitcoin, you've probably seen there's this issuance curve. By the year 21 something something, all Bitcoins will have been issued. And there is this halving that happens at certain points throughout. So there's a smooth sort of issuance curve of Bitcoin for the next 100 years or so. So this kind of gets at the dynamic supply idea because it is expanding, but it's expanding according to a preset rate that does not necessarily take into account any other factors of the network, the Bitcoin network, that may be relevant, such as, what is usage like? What is, the production of this ecosystem? Does it need more tokens? Are more tokens just being created because someone decided 100 years ago that was the thing to do? What PAMs give us is the ability to set more customized and dynamic feedback policies for supply expansion when that need arises. So in other words, if people are, trading the 100 Jeff tokens that are in existence, and that's all that, needs to be in existence, then that's enough tokens. However, if there's someone, who needs the 101st token, or the 102nd, 103rd, and so on, the PAM basically opens up this issuance market rather than an exchange market where anyone can put dollars in and more tokens are minted. And of course, the PAM and the SAM are connected in a way because if you're trading on a SAM and you're trading so much to one side of the trade that the price appreciates over the price of that token on the PAM, then someone can go over to the PAM, put money in, mint it there, and sell it on the SAM and actually make an arbitrage profit by responding to the needs of the system, seeing that there's actually so much pent-up demand for this token that more tokens should be in existence. So going from the PAM, where tokens are issued, to the SAM, where tokens are exchanged, this arbitrageur is now solving somewhat of a supply discovery problem in this ecosystem. Because if the token price on the SAM is way higher than the token price on the PAM, then there's a financial incentive to go and increase the supply of that token, feed it into the market of people exchanging this token, and thus the supply can increase and or decrease to where it needs to be. And I think that's an important, these things don't just go up, they also go down. And I think having a managed and predictable increase and also managed and predictable decrease will change the game in terms of how we can use these tools for things like managed degrowth. I know a lot of people in crypto are excited about number go up, but I think there is probably a more pressing problem in that society systems don't know how to go down without exploding. Our economy can't stop growing, or kind of everything stops working. And same thing with companies within that economy. If you can't keep growing, if you can't keep investors happy, you go bankrupt, you kind of explode. So there is a lack of sustainable growth and sustainable degrowth. And I think bonding curves, in particular PAMs as dynamic supply mechanisms, can help to give predictable and manageable increase in not just token price, but also token supply, and make sure that the needs of the ecosystem are met by the amount of tokens in existence. And I don't think there are that many tools that exist today outside of people looking and taking a best guess. So I think these are really interesting tools that can help us upgrade sort of the economic substrate of these token ecosystems. Any thoughts or questions, feedback on the PAM side of thing? I was going to jump into one more, talking about the CMM, or the Commons Market Maker. And then I was going to talk about sort of access control for different user types within all three of these ecosystems. But any questions or comments in the meantime?
I have one question, Jeff. Really great presentation, really enjoying this. I'm hiking up a pretty steep hill, so I'm kind of out of breath, but I'm wondering if you ever consider the combination of dynamic issuance and continuous issuance, because it seems like they both have pros and cons, and there might be a hybrid model, because a continuous issuance could be good for a funding flow for a team. It's like proof of work, right? Classic proof of work. You do the work, you get the tokens. And there might be a budgeting flow model that maps to continuous issuance, and we might be able to pair these tools together. What do you think about that?
Certainly. So I think there are different layers of policy making that are possible here. And I think what you're talking about is essentially a treasury management policy. So when we're talking about PAMs and SAMs, I guess I could draw some of these actual structures we're talking about, because in the SAM, you have two pools of tokens. This is going to be really difficult to draw, isn't it? And they are kind of weighted against each other. So if you kind of picture, these are on scales, and you have sort of this dynamic weighting of token A to token B. That is a terrible scale, but hopefully you'll forgive me. With PAMs, right? So let me change color here, and we're going to add in one more. So we've got the reserve, and we have the common pool, which is also a treasury. So this is a, oh, it's not going to work if I write that small, is it? Okay, you can just bear with me on that. So what you mentioned, Sean, is basically a treasury allocation of this pool. So you're saying, hey, we have a common pool. It is separate from our reserve. So when you put money into this PAM, there is a portion of it that goes into a reserve to backstop exit liquidity. So if someone buys a token, they can always sell it back, because there's a reserve that is reserved for buybacks. The common pool, or the discretionary treasury, is a different beast. So anyone who is participating in this economy can presumably participate in the policy making over that shared treasury. And if we say that we want to stream out, let's say $1,000 a month to every contributor for the work that they're doing, it doesn't even have to be a set amount. It could be, the amount of deliverables you produce. That's the stream amount that comes out to you. So there's different layers between the money coming in and going out of the bonding curve, and the money coming in and going out of the common pool, which is a subsystem of that PAM. Does that make sense? So in other words, yes, we can have both. And I think that's a really good idea.
Jeff, I really enjoy this so far. I think your board work is great, in all honesty. I do have a question / comment. It seems to me that this would correspond to the idea that PAMs correspond to the idea of a source / sink in network theory, and that SAMs would just be ordinary edges. And so do you agree with that conceptually? I think it could be useful even for like modeling flow problems to think of it that way.
For sure. Yes. So source and sink. I guess I come from from an electrical signal. So we have um, tokens coming into existence. That's a source. Tokens going out of existence. That's a sink. Tokens transmitting across. That's just a transfer. So that would be a SAM. So I agree. SAMs would be like a gradient or a transfer of tokens. PAMs would be the source of where tokens come into existence, and the sink of where they go out of existence, based on the mint and the burn. And that's, I think, one thing I really want to, and it doesn't have to be these words, but I think clarifying terminology between these different mechanisms would be really helpful. So on a SAM, you're buying and you're selling. It's a market. On a PAM, you're minting and you're burning, because it's the feels the same. You're putting money in, you're getting tokens out. But the thing happening underneath is fundamentally different, because you are minting, you are increasing the supply, and you are burning, you're decreasing the supply. And when we come over to CMMs, so let me slow down a second and get back to, why did you do that?
So to put that in the terminology, I probably learned from you or your friends we used in the TE fundamentals course. The SAMs conserve the invariant property of token amount, and PAMs do not.
Can you say it again?
Yeah, so one thing to look at in agent actions is whether they conserve a quantity or not. And SAMs do conserve the quantity of token amount. Interacting with a SAM does, whereas interacting with a PAM does not.
Yes, agreed. Cool. Okay, so the third concept that I want to introduce here is, I mean, it's CMM. I don't know that this is the right term to keep it under, but in a lot of the work that I've done in the past year or 2 years with the mutual credit community, and I mean, even both of these systems, the PAM and the SAM, are plutocratic in some sense. You buy your way in. You put in dollars or some proxy for dollars, and you get tokens. And now you have governance power, and you have the ability to participate in arbitrage and all of that stuff. But it all requires money off the bat. A lot of the work that, for example, Will Ruddock is doing in Kenya with the CICs, if anyone's not familiar, the way that they issue community inclusion currencies is through chamas. So chamas are basically like local savings and lendings groups, and they'll get a dozen villagers or heads of households of the village together, and they will all sit down and say, okay, this is what I'm going to produce in the next 3 months. I can grow $100 worth of tomatoes. And the next person says, I can give $200 worth of taxi rides. And the next person says, I can give $300 worth of haircuts. So everyone basically has an obligation or a promise that they put into the middle. They go around the whole circle, they see the promises of everybody, and then they take the lowest amount that anyone can offer. So if I could only offer, let's say, $50 worth of water in a month, then everyone only gets $50. But what they actually put into the pool to issue those CICs is a promise. So we can call this, I drew a little tree here. Maybe this is a carbon credit. So I've got trees on my land. I'm going to put in a promise that this tree will sequester a certain amount of carbon. So I'm not actually putting the tree into the bonding curve, because you can't, but you're putting a promise, an obligation, that by X period, maybe 1 month from now, I will have produced this output, whether it's carbon sequestration or growing carrots or whatever you do. And at the end of that, I have to be willing to redeem or accept back the token for the output that I produce. So if we are a carrot farm, let's say, and I issue ahead of time at the beginning of the year because I need to cover my costs of growing carrots, I've issued a promise that I will deliver 1,000 carrots. Just admit Isaac here, okay. Then you have the subsequent redeem at the end of that period, the tokens come back from customers and you deliver the product that you promised. So it's not so different from a PAM because these tokens are being issued and they're being redeemed just like they're being minted and burned for dollars here. The difference would be that the PAM is primarily used by the customer and the CMM is used by the producer. And I think this is a bit of a challenge in token ecosystems that I've seen lately, that the value producers, whoever it is, shouldn't have to put money into these systems in order to be part of the system, because we don't actually want their money. We want their goods, their services. And some of these groups may not have the money to put in, but that doesn't mean they don't have value to offer. They actually have core production in whatever form that may be, whether it's eco credits, whether it's local farming or syntropic agroforestry. So the CMM really gives a way for people without money, but with promises of value, whether it's their labor, whether it's their materials. They can basically issue tokens based off of the promises of their labor in the future. So I guess I can stop for a second. And does that make anybody confused? Is there any questions? Or I understand this also breaks the invariant. So this all of a sudden means when we introduce a CMM, we lose the hard relation between number of tokens in existence and amount of reserve backing them. So there is a trade-off here because we lose that nice invariant where you can look at the supply of tokens and know exactly how much is in reserve and therefore exactly how much someone can get on exit. This CMM kind of introduces a bit of a inflationary aspect. Actually, in the TEC hatch, this would have been the builders, right? So a bunch of people put in time before the hatch, and they were issued an allocation of tokens based on the time that they put in. And you can see it from a capital's perspective, that was inflationary because people who put in dollars into the raise got a proportionally smaller amount of the total tokens issued because some of those tokens went to the people who did the work rather than putting in the capital. But I think having this as a separate and identified segment of the ecosystem, because all three of these can be stitched together as well. So you can have one ecosystem, and I think actually a well operating ecosystem will probably need all three. CMM for real value production, the PAM for customers to be able to put money in and receive the tokens by which they can redeem for whatever the output of this DAO or community might be. And then SAMs provide that liquidity, they provide the exchangeability to other ecosystems, and they provide sort of a buffer. You have some liquidity in this pool, so when people want to trade from that to ETH or from that to anything else, there isn't this no one to buy from, no one to sell to, the price drops out and everybody panics because sell pressure on tokens can be a double-sided sword. But I think with these sorts of mechanisms combined together in an ecosystem, we can start to see a lot more stable, less volatile ecosystems, but also ecosystems that prioritize people and production over sort of financial speculation. These aren't tools just to put money in and take money out and see if you win. Ideally, they are engines for productive growth. And in my mind, the CMM is that kernel at the center of these economies where this is the real value. Whatever is being offered in response for these tokens being issued and being redeemed for at the end of that loop. In Hollow Fuel, this might be Hollow tokens for hosting. So Hollow hosts have a mutual credit. They are able to issue Hollow Fuel to cover their costs ahead of time, but they have a promise that they will accept Hollow Fuel in exchange for the hosting that they promised in the beginning. And then interestingly enough, they can only sell that on the PAM, or sorry, not sell it, they can only burn it when they've earned it. So there's a few different things we can add in here. If we look at sort of stakeholders, I'm on the right color. So let's call this the earn Ay. Earn to burn. I apologize about my writing here. Let me zoom out here for a second. Any questions so far over the three different types of bonding curves that we're talking about here, how they might fit together in an ecosystem? And the next step I'm going to do is look at different kinds of stakeholders that may look to interact with these systems and how we can eliminate some of the free rider problems and the Ponzi dynamics of bonding curves by limiting access or providing access control for certain groups of stakeholders over certain mechanisms that exist in these systems. But I'll give it 1 second in case there's any questions or thoughts.
Yeah, I'll raise my hand, Jeff. This is really great. Thanks for doing this. So the relationship between SAMs and PAMs is pretty clear. The reserve asset for the PAMs is the swap token for the SAMs. I guess what I'm trying to understand better is the relationship between the CMMs and, well, either PAMs or SAMs. So they're like, and you're starting to go into that now. So maybe this question is premature. And if you, by redeeming one of the tokens on the CMMs, what you're actually doing is burning it on the PAMs. So you're changing the supply on the primary market maker by redeeming on the CMMS, right?
So let me think about that. You might be able to do it multiple ways. So this might get a little clearer when I dive into some of the stakeholder affordances. So generally, okay, yeah, why don't I jump into that? And I don't think it will be that difficult. Okay, cool. So let me zoom
Jeff,
in here. So
can I ask a quick clarifying question? Did
Sure.
you indicate the CMM as the tokenization of obligations, like agreements, kind of like scaling the community currency model? Or the CCM is the community currency model? Is that what you were saying? Does that make sense though? Like scaling, it sounds like the end game is like scaling the tokenization of obligations or agreements so that those can be pooled, so that at the end of production, at the point of production, there can be a value representation that can sort of get pooled against dollars, say, from the get-go, so that at the nodes of production, there's not a requirement for capital.
Exactly. Or at least we're trying to reduce their requirement for capital. So if anyone's familiar with CICs and Will Ruddock's work, he's basically doing this. He doesn't have PAMs. He doesn't actually, I guess the swap pools that he's been talking about would probably be similar to a SAM, but mostly Will's system today is a CMM. So people commit promises. They value those promises in Kenyan shillings. So this might also close the loop on some of your question, Tam, because once you're putting in trees or tomatoes or what, there's another question of, right, what are these things valued at? So the way Will addresses this problem is they value everything in Kenyan shillings, and this is mainly for simplicity for their users. They don't want to introduce, another valuation of a currency. They don't want that to be floating because that's will be difficult for people to grok when you're interacting with these systems. Okay, let's jump back into. So let's have 3 user types here. So let's call these users. And let's call this the value producer. I'm probably going to shorten because my writing is so difficult on here. Value producer, let's call this a customer. They want this value that is being produced in whatever form. And let's call this person a speculator. They are just interested in, the tokens, in, arbitrage opportunity. Let's just leave it at spec. Okay. So, whoops, didn't mean to do that. Is there a back button? Yes, there is. Cool. So what we can now do is give each of these sort of permissions. So on the SAM, I think it is okay for almost anybody. So the value producer can buy and sell, the customer can buy and sell, and the speculator can buy and sell. So both of these have more or less all users being able to access. Oh, I apologize, it barely looks like it. So anyone can buy and sell on the open market, which makes sense because it's supposed to be an open market. It's an exchange protocol. Anybody can buy and sell. But when we come over here, and I guess I got ahead of myself a little bit with this earn to burn down here, because ultimately what we are saying is, while anybody can mint, because it might provide, an arbitrage opportunity for the speculator, or perhaps the customer isn't able to get enough tokens on the SAM, so they come over to the PAM and they mint more. They put in dollars, they get their tokens. But we're going to restrict the burn to, oops, that's not restricted to them. Let's restrict it to the value producers. So the only people who can burn to the PAM, now keep in mind, you can sell on the SAM, but you can't burn on the PAM unless you are a value producer and you've fulfilled your commitment. So last year you said you were going to put in some things. You got these tokens, or you got this remuneration. Great. Did you deliver on your promise? Did someone come by and claim your carrot token or claim your carbon credit? Cool, they did. Now you can take that and you can go burn it for the external collateral. So there's kind of two loops here. And this is why I wanted to get into some of this to answer your question, Pam, because the redemption is actually a customer paying a producer for the good. So if I produced a carrot and you have carrot token, for you, the user, you've now redeemed your token for carrots. That's your loop. And I think it's important to consider all of these tokens in issuance and redemption loops, like the source sink. What comes into existence and then goes out of existence when that obligation is complete. So for the customer, your circuit is complete when you trade carrot token and you get carrot. But really, there's kind of now another layer of that onion, because if I'm the carrot producer who's just been paid in carrot token, I can now, because I've earned it and I can only burn what I've earned, I can now go back to the PAM and say, hey, PAM, I earned this carrot token. I can now sell it. And presumably, because there's so much more potential for buy side pressure than sell side pressure, the burn price on the PAM will probably be higher than the sell price on the SAM. So you kind of get access to a privileged market, like a guild market or a producer's market. So keep in mind, everyone's buying here, everyone's selling here. So these are fairly, well regulated with each other. On the PAM, however, anyone can mint, but only value producers can sell, and only what they've earned. So you really have sort of an algorithmic guarantee to that contract, the contract that they entered into here by promising their goods, and the contract that you entered into by buying a token, which ostensibly gives you access to those goods that are produced. But by limiting the the stakeholder affordances to just the value producer, you create an asymmetry in sort of the pressure, which, I mean, it doesn't necessarily guarantee a privileged price, but all else being equal. And I think there's a lot of modeling that can be done here that would be super interesting. Also on the issuance, only value producers can issue these tokens because they are, and I mean, anybody can be a value producer. So this is another thing. Value producer being the only one who can issue and or burn doesn't mean that that's only one group of people. These could be permissioned access, right? So you could opt into being a value producer. If I looked around the web and I saw that, I don't know, the mushroom economy had a huge premium, then I could jump in as a value producer in that economy. So it's not saying that anyone is necessarily left out. It's just saying that if you want to take advantage of the asymmetrical value in this community, then you have to be a value producer and you have to produce what this community finds valuable. On the redemption side, I think we can probably say anyone can redeem. Oops, that's a terrible rectangle. So customers can redeem, speculators can redeem, but they probably don't want to. I mean, the speculator is primarily here to play, honestly, between these markets, and earn arbitrage opportunities, which is an ecosystem service. Perhaps we can get even better with those, maybe with Uniswap v4 hooks. We had a couple of talks with the BCRG, and Rex talked about syncing PAMs and SAMs through Uniswap hooks, so that a buy order that was placed would settle on either the SAM or the PAM, whichever the price was more amenable on, and that would eliminate sort of the UX overhead, the attention overhead for a user trying to figure out where to buy. Also, this might be slightly confusing for different markets to have different prices of the token, but I think this is actually also a very interesting engine. The Economic Space Agency guys call it living in the spread, and I think it will do some interesting things to give not just investors, but also value producers sort of an idea of the direction this economy is heading. Because you may have a lower price on the SAM and even your mid price on the PAM, but your burn price could be well supported by a treasury, because only the value producers can exit, and they can only exit when they've actually earned, completed their obligation. So you have much more upside pressure than downside pressure. And now you have basically this privileged market position for value producers in this online guild to produce what they're producing and receive sort of it's kind of an economic buffer for them. They're yeah. Maybe I should stop again and ask. Did I answer your question, Tam? And did I address your question, YGG?
Yeah, that made it a lot clearer. The relationship between the CMMS and the PAMs, and it's the redemption of the value that's been issued when initializing the CMMS.
Cool. Yeah, so, and I think there is still so much room for customized design in these ecosystems. Whether these tokens come into existence and out of existence here versus here, I think there's still a lot of room for contextual requirements and specific designs to achieve goals of very different business models even.
Can I ask maybe another question? What happens to the unredeemed value that's underlying the CMMS?
Good point. Actually, I was doing a bit of thinking. I'm just wondering if I have any other diagrams here. I think we should consider that sort of the capacity, the productive capacity of these communities. So let me see if I can draw here. Okay, so I really like these cellular analogies because and I think that's, designing like the natural world is probably not a bad idea. It's, evolutionarily tested. A lot of the kind of analogies I use around bonding curves, I try to like lean towards this biomimetic, and it also just makes sense. The more money that is transmitting in. So if we've got, dollars here, they're bonding to the surface of the economy, and then a token is released in here. So that's a really bad picture, but if you could imagine, that is dollars bonding to the surface of this economy and then releasing a token live into the sort of internal economy of this bonding curve project. Sorry, what was your question again, Tam?
So it's just that when you're initializing a CMMS and you are deciding the value that each of the community member can contribute based on their production capacity, some portion of that may not be redeemed. And how does that impact this entire system? Because there will be right? I'm assuming not, I'm assuming it won't be like what they have considered to produce will not be 100% redeemable.
Right. So what they produce is not redeemable. So I'm really curious how we can visualize the health of these ecosystems using sort of like the ratio of liabilities to assets. So let's say, and I mean, let's continue along with this analogy. If we say a bonding curve is literally, there's all these dollars outside the bonding curve, and when they get to here and get deposited, they kind of like accumulate. The dollars don't actually enter the ecosystem, right? Because inside the ecosystem, it's all our native token. So the dollars just kind of accumulate around the outside of this. And we might even be able to look at that as a, like a status bar or something. Like maybe there is some like this curve is, this full. We've got this amount of assets, right? But what's the other side of the assets is the liabilities or the obligations. So we might even have, within our economy, we've got a certain amount of obligations on behalf of the participants. And I mean, I'm obviously scribbling this. You can have higher level data about the system visually displayed to users such that they can see at a glance, oh, okay, the commitments of this community are way beyond their assets or their ability to gain customers for those liabilities that they're looking for. So if you saw, for example, a situation, if this wasn't here, if they only had this much assets and this much liability, this would be a very unhealthy ecosystem. And that might be a signal to the team that the product that they're offering does not have demand. And on the other side, we could say, okay, because also liabilities aren't a static thing, they're being issued and redeemed all the time. So this might be a dynamic dashboard. So you can see, our liabilities are increasing. You can see they're increasing faster than our assets. Or we could see that, perhaps our asset buffer is actually much more, healthy, and we can dig into, further R&D or asset expansion of our project. So I think having the ability for the reserves rather than just having a number on your dashboard. I know it's our current dashboards are like, okay, we've got 200K in reserves, cool, but what does that show relative to the internal production processes of this organization? So if you combine together the SAM, PAM, and CMM, I think there could be a potential visualization for how many assets does this community have? How many liabilities is this community responsible for? What is the rate of growth of either? So we can project, forwards. We can say, oh, in 3 months, look, we are going to have more liabilities than assets. We really need to pick up our productivity. Or perhaps, we haven't found product market fit. We need to, there's all these pricing signals in here. So I think one of the things I've realized about these tools is you really need a thing people want. And I think it's great to come back to that realization because these aren't magical money tools. They are, in my opinion, efficiency gains for good products, or good things people want. If you have a water commons, this might be because everyone needs water. There's no question that people will need water. But if you have, an economy around, blue striped kazoos, maybe you will have a lot of interested speculators in blue striped kazoos, but actually you realize after all that money's been put in, the customer base isn't there for it. So cool, good thing you used the bonding curve because all of those mistaken VCs who thought blue striped kazoos were going to be the thing can all get their money out, or at least reliable portion of their money out, because most of that went into reserve. Sure, maybe some of it went into the common pool, and that was used by the blue stripe kazoo team. But in a year, they look back and they said, "Wow, we really didn't hit product market fit." Cool, all of our money or most of our money is still in that reserve, and we can actually exit. And I think that's another powerful aspect of the bonding curve that needs even more amplification is sort of that the guarantee, or Griff called it the rage quit guarantee, that if you don't like what this project is doing in some period of time, you have a mechanism that you can go with your tokens and reclaim at least a chunk of your initial investment, which I think for most people in the crypto space, if you put money into an early stage project and in a year they're not doing anything useful, your value has probably gone to zero, and there's very little capabilities to reclaim that investment. So I think there's some really interesting opportunities with these tools to bring us into a new age of predictable, reliable, and much more safe token issuance mechanisms. Any other questions or thoughts? Oh wow, we're almost at the top of the hour already.
I was wondering if you could say a bit more about how you think about differentiating supply discovery from price discovery, because I mean, in quantitative economics, there's a curve where price is basically the relationship between supply and demand. So I don't, with that relationship in mind, it's kind of like, if you know two of the things, you know the third. So how do you think about differentiating or disentangling those things?
So I agree, there is a relation between the supply increase and the price increase, at least in the implementations that we've been discussing of PAMs. So I guess I look at these as nested systems. So the PAM would be the external edge of the cell. And actually, I was doing some reading the past months where there was someone talking about the origins of life, and they said the origins of life came with the cell wall, because as soon as there was a cell wall, there's an inside and there's an outside, and there's something unique compared to the environment. And I think the PAM is similar to that cell wall, because that is the membrane of growth and decay within that ecosystem. So if there is a source, if people are putting money in, that economy grows in size. If there is a sink, if people are taking money out, that economy shrinks in size. Now the SAM is within that. So you can kind of, if we just draw here, let me just put a little, and then change color. So if we put a little organelle in here, perhaps, now this might be a SAM. So within, and actually it's not really within, because it's kind of between, actually. So a SAM would be between this ecosystem and perhaps some other ecosystem over here. So maybe one is the Jeff economy and the other is the octopus economy. And the SAM that holds Jeff tokens and octopus tokens is actually kind of bridging between these two. But the SAM doesn't actually create or destroy anything. It just moves around. So maybe there's someone who's really interested in Jeff tokens and not octopus tokens, and then vice versa. So those kind of just transfer back and forth. The PAM, as the supply discovery tool, makes that blue circle bigger in the Jeff economy or smaller, and makes the yellow circle bigger or smaller in the octopus economy. So they're definitely linked. They're not completely separate functions, because the price on the PAM affects the price on the SAM and vice versa, or affects the behaviors of people, what they may be willing to do. Because if I see the Jeff token is cheap here, I can buy it on the SAM from someone perhaps in the octopus economy who does not value Jeff tokens. I can buy them cheap, and I can sell them to the PAM of the Jeff economy if I'm a value provider. Now, we're kind of getting down the rabbit hole with some of these access controls and permissions and whatnot. But essentially, there's arbitrage opportunities between the PAM and the SAM. So they're definitely interlinked, but only one of them changes the actual size of the token supply. And that's the PAM. And the SAM more or less just transfers between that economy and other economies and helps price regulate between those economies, which then may involve a supply increase or decrease of any of those economies that the SAM is a part of. So they're definitely all intertangled, I guess, is my intertwined is my short answer.
So what I think I understood that, but I would like to follow up if I could.
Sure.
But it from my perspective, I see that as the overall project of the value increases, either the price will increase because of, there's not, people think this thing is you can't get enough of it, right? So the price goes up, or the supply will increase, which stabilizes the price. But in either case, it seems like sort of the underlying value of, whether it's measured in market cap or whatever is the same, and you're just changing which variable is moving. But the dynamics of what is happening are actually the same. It's just a matter of how that's being measured. Does that make sense, or do you disagree?
So the outcome from the user perspective, and that they're putting in dollars, receiving tokens, or the outcome from the actual state of the tokens? Sorry, just clarification there.
Yeah, so I mean, a price is a relationship between two things, and kind of like inflation, you can increase the flow, but that doesn't actually make the thing worth more. Like when the value of something increases, it could either increase by having the same amount and the price going up, or by the price staying the same and the amount going up. But for things that are, like very divisible, what is the difference between those in terms of the like collective impact?
Gotcha. So it strikes me, are we talking about then market cap, like effect on, so price up, supply same versus supply up, price same?
Yeah, if your project suddenly increases double in value, what is the difference between doubling the price while keeping the supply the same versus doubling the supply while keeping the price the same? Because you're saying that these two do different things, right? And one is sort of an outlet for one effect and the other is an outlet for the other effect.
Yeah, good point. I don't, it strikes me that from a, PV equals NRT type perspective, those two situations would be the same. So this also strikes me as, do we need supply increases? Like I've heard people say about Bitcoin, when there's no more Bitcoins being used, well, we'll just start using like 0.1 of a Bitcoin or 0.01 of a Bitcoin or 0.001 of a Bitcoin as the standard unit. So really you can, I mean, with tokens as digital things, you can always slice them up smaller and smaller and smaller. So in that sense, I think there is, you don't really need additional supply if you can just cut each token to be smaller and smaller and smaller. But when you start to take these things and redeeming them for real world things, so if I had 1 carat token at $10 versus 10 carat tokens at $1, that may affect the redeemability of that for a real world good. So if I show up with 0.1 of a carat token, the carrot farmer might say, well, I can't sell you 0.1 of a carat, you need 1 carat token. So I think that it depends on the context of the situation we're talking about, because if we're talking purely mathematical, I think those things are the same effect. But when it comes to regulating real world resources that aren't necessarily infinitely divisible, because you have some point in time in the past where people committed goods to X amount of tokens. So now in the future, if you are going to change the value of those tokens, the people who were issued those tokens initially, or I mean, if you're going to change the supply and price dynamics of those tokens, you already have real world goods committed. And those real world goods may not be divisible, the same way that digital tokens are. So are we touching on the does that make any sense? Am I answering your question? I guess that's my my first question. Am I in the right realm that we're talking about? I think theoretically, mathematically, you're exactly right. When it comes to real world goods, maybe there is more need for this kind of supply issuance. And actually, that reminds me, I have a paper I want to share here. Thomas Edison had a paper on his theory for ideal money, and it's actually quite similar to this. And I just want to drop that link in here, but I also want to give you a chance to reply to that, Octopus.
No, I appreciate what you said. Maybe we can talk about it more outside the meeting. I don't want to run over by too much. I think the thing is, for me, it's difficult to distinguish price volatility from high variance of opinion regarding value of something. And it can be, I feel that dampening price volatility is kind of, is forcing people to hold a particular view, whereas that may not be accurate.
Yeah. I would say the deterministic operator that we're talking about here is essentially a low pass filter. So we're not saying that token price can't change. We are just saying let's take the damped change over time rather than going up really rapidly, dropping really rapidly, going up really rapidly, but trending upwards with a low pass filter, which is sort of what this PAM and SAM CMM, I think less so. The arbitrage between these kind of acts like an inertial damper. So instead of having a token price that goes crazy high, crazy low, crazy high, crazy low, crazy high, crazy low, but on the way up, you just have the on the way up. So you eliminate sort of the high frequency noise and you focus on the low frequency signal, whether that is this is increasing because people value it and are using it, or it's decreasing because people aren't using it and therefore don't value it. So we're not a very good point. I don't think we are trying to eliminate people's sort of preferences or response on the system. What we're trying to do is streamline it into a signal that is not damaging to the ecosystem that it exists in. Because I think a lot of these pump and dump dynamics create their own panic cycles. And I think that's one of the biggest problems to mass adoption. I don't think mass adoption is the thing we should be looking for, but building useful tools requires them to have people's trust that they won't explode either up or down, because I think that can be damaging on both sides. So it's more of a low pass filter that allows people's preferences to come through without all the high volatility kind of speculative like up and down. Yeah.
I'd say
Rex?
It changes, or this dual structure changes the fundamental like demand of money. So I know Keynes talked about 3 different demands of money, right? You had the there was speculative, definitely, as it dampens the price volatility, but with it becomes a more usable good because if you are talking about real world applications, it becomes more of a flat coin, let's say, than this new trendy term. So I think it just changes the game theory of agents within the system. This difference between having price and supply volatility.
Yeah, I would agree with that. I think there's, the outcome of these systems, and I mean, I don't know how much we can say that looking forward, given that we haven't seen it happen, but ultimately these, in my mind, are sense and response regulators to find the market price, and I say market, I don't know if that's the right term for a given good. So if we are the carrot economy, then there will be a bunch of market forces for people to determine how much a carrot token should be worth relative to a carrot. And then of course you have all of these future environmental options, risks. It's a lot of it works out to be similar to options, call and put options, and futures. So the carrot producer has some risk in their production's life cycle, maybe there's a drought, or maybe there's a hurricane, and they can't produce what they said they were going to produce. So there is the need for speculators in the ecosystem, and this happens in financial markets today. And I think we're talking about very similar things, but we're talking about lowering the barriers to access and putting the value producers in charge, which is what I was really excited about with Thomas Edison's monetary option I just dropped in the chat. He talks about farmers being the core producers and the money being based on the production of the farmers. And I think we are taking that and generalizing it and saying, yes, farmers and anybody else who's producing value. If you are any kind of economy, you could use this type of system to issue the money first, be able to sell that money on some form of, sell those credits on some form of market. So someone else who wants to maybe have access to the future production of carrots, or even speculate on their value between this year and next year. And then you can redeem or earn those tokens back by by redeeming your goods for those tokens, and then take those tokens to the PAM and sell them for your dollars, or stay invested in your economy. So you really are giving the value producer optionality. Do they want to sell for cash and either claim a profit, or maybe reinvest those profits into more production? Or do you want them, or do they want, it's their choice. Do they want to stay co-vested in this carrot economy and use their clout and their weight to help steer those treasury funds? Maybe they have a new proposal that all carrot farmers should be streamed those funds, which is what we talked about earlier with Sean in terms of this treasury policy. So I think it basically just puts the value producer in a privileged position, and it reduces the speculators to sort of second-class citizens. They can come, they can play, they can possibly even earn a profit if they do the right things in the right order, but the dog wags the tail and not the other way around. And I think that's the problem in our current system, is we have way more speculative activity than we have real productive activity. And if we embed these types of systems with these types of access control, we may be able to address some of those free rider problems and put finance in service of the economy rather than the other way around. And I see we're already 10 over, so I apologize I've gone on so long. I'm happy to, I love talking about this stuff, so if anyone has further questions, we can definitely still chat. But if people have to run, totally understand. And it's been great talking about this. Looking forward to the next one. Cool. We'll do some more whiteboarding next time.
Thanks, Jeff. This was so much fun.
Yeah, I agree.
Thanks, Octopus, for all your inputs as well, and everyone in the call. That was a joy.
Yeah, agreed. That was really excellent. I really enjoyed that. I learned a lot too. Okay.
Cool.
Bye, fellas.
Yep.
Thanks all. Catch you again soon. See you later.
Bye.